Hello, Peter with Never 6% Realty. Today we're going to talk about warrantable and non-warrantable condos. What does that mean, that verbiage, and what does it mean to you as a buyer, and what does that mean to you as a seller, and how does that affect the financing? So let's start off with warrantable condo. A warrantable condo meets Fannie Mae and Freddie Mac's lending guidelines. For a lender, this is so important, making it easier to secure a mortgage with favorable terms. So warrantable is something that we need to look into. It's a word terminology used in the lending world when it comes to condos and how to secure the financing for this type of property. So the question is, why is warrantability important, especially in the lending world? Well, warrantability is important is because easier financing, more financing options, higher property value. Think about this. If you have more financing options like conventional VA, FHA, then you're going to open the doors to all these other buyers that can come in and make offers, making it a more valuable property compared to a property that's non-warrantable that can only strictly take cash or hard money lending. And we'll get into the non-warrantable in a second. So when the lender looks at these guidelines, they cover these certain factors like, hey, owner occupancy rate, the financial health of the condo association, and limits on single entry ownership. Essentially, a warrantable condo is considered to be a lower risk compared to a non-warrantable condo. So, here are some examples of what makes a condo warrantable. Again, owner occupancy, significant portion of the units should be owner occupied, homestead, primary residence, not just rentals. So lenders look at this. They want to make sure that there is more owner occupancy than there are rental properties in that building and that complex. Financial sustainability of the HOA, financial health of the reserves, if there's assessments, if they have insurance that covers the complete outside of the common area. For example, we had a condo that we were closing in Flagler Beach, and reserves were good, financials were okay, rules and regulations were what they were, and but the problem was the way the insurance in the common area covered, it didn't cover the pavers. Go figure. Because of this small detail, the lender did not want to lend on this. They didn't want to give financing because it was considered to be a liability. But we went around that. Long story short, we were able to close, but it did cause problems in the beginning because of the way they had the insurance in the common area and how that was handled. So other aspects of being warrantable condos is the completion of a project. If there's a new complex, a new condo building being built, and it must be so much percentage being completed at a time, or a big portion has to be completed, and there's a ratio to consider it to be warrantable. And that's really up to the lender to decide exactly what that is. Besides that, you don't see so much here in Ormond and Flagler when it comes to commercial spaces underneath these condo buildings or in these high rises. But I'm from Miami originally, and I've been up in Ormond and the greater Daytona area for 20 years. But back in Miami, it's very common to have a huge high-rise building, and on the bottom you have retail restaurants. And again, how much of the commercial space is allocated towards these restaurants and businesses, and the ratio has to be in such a way that there's so much commercial space within the condo complex, and it can't be too much or it won't be warrantable. So this is another important factor, detail that you need to look into as a buyer. Okay, in the beginning we kind of touched on the non-warrantable lingo, dialogue about what that means, but a non-warrantable condo is where a home buyer cannot get conventional FHA, VA financing, or USDA mortgage approved. That's because the building fails to meet basic financial standards. So if you have a non-warrantable condo, because the outside insurance does not cover the pavers, for example, what happened to me, or the ratio of renters compared to actual owners that live in the building, it's off, the ratio. Or because there's not enough reserves or the assessments, this all falls into place with it being non-warrantable. And lenders do not like this. So then you're left with basically hard money lending, which is private lending, or cash buyers which is not good because then you're closing the doors to all these other people that had conventional and VA and FHA and all of that. And you're pretty much catering towards the buyer who's cash or hard money lending. And people with cash, usually, they want a better deal because they have leverage, they have cash. There's less contingencies involved with the contract, and they're gonna try to undermine the price, bringing down the value of the condo and the building itself. So keep that in mind when investing again in condo buildings, warrantable, non-warrantable. Here's a few other things that can affect the condo to make it non-warrantable. Litigation, pending lawsuits affecting the condo complex makes it non-warrantable. Insurance requirements, the condo must have a specific standard insurance. And again, in Florida, we're seeing a lot of problems with insurance. People getting policies, the insurance has gone up over 100%, causing the HOA fees to go up. So it's going to be a point that I believe in the near future that some of these condo buildings will be non-insurable. I don't know if that's going to happen anytime soon, but there's going to be a point with the way the environment's changing that's a possibility, and it would be a cash-only way of buying some of these properties, making it non-warrantable. Hey, thanks again for watching this video. Give a thumbs up, it's free. Real estate is expensive sometimes, that's not free. Appreciate you looking into this video. If you have any questions, you can call me. I'm gonna leave my number on the screen. Love to hear from you and see you in the next video. Have a great day.